Have a listen to this. Have a listen to this.
Interest rates are higher. I know people don't like that, but you should be welcoming the stronger economy.
And maybe a deal has a point about the machinery of capitalism being oiled with the blood of the worker.
The United States is a country that has always paid all of its bills.
Lannister always pays his debts.
Don't let the bastards get you.
Hello and welcome back to Comedian versus Economist. My name's Adam and we're joined as always by my little older brother and real life economist, Thomas. Hi, Thomas.
Yeah, g'day, Adam. How you going?
Doing very well, thank you. Thomas, as always, we're looking at charts here on CVE. Charts. If you want to follow along with the charts, you'll find them on Facebook and Instagram at CVE Podcast, as well as on the CVE page of the Equity Mates website, equitymates.com/CVE. Thomas, huge show coming up. I don't want to get all sentimental, but we'll be talking about consumers and their sentiments. Always brings a tear to my eye. And we like land lots, but the lots of land are getting smaller and more expensive. Will we like land less? And have we finally lost faith in the media? The number of people who still trust mass media might surprise you. Spoiler alert, it's more than 3 people. But first, Thomas, open the good champagne, break out the good cups. Inflation is back in the target band. When do we start celebrating?
Yeah, no, we don't.
What?
There wasn't a good result. I mean, headline inflation back in the band at 2.8%. That's
Fixed.
Nice.
Fixed. Job done.
Job done. No. Because the trim mean measure, which is, you just, people know the trim, you just take off I think for the RBA, it's the biggest 15% of movers are on the upside and the biggest 15% on the downside. So you take out that 30%, you look at what's left. That gives you your trimmed mean.
Movers in what sense? Movers in
in the
basket.
Yeah. It's in the basket of goods. So electricity prices fell 17% in the quarter. That's one of the biggest moves by far. That puts them in the top 15% of moves to the downside. That gets trimmed out.
Okay.
That makes sense?
Yep.
So the trim mean, and that's what the RBA sort of cares about. That came in at 3.5%, which is still too high. Too high for the RBA to be cutting, particularly given that there's no dramas with the labour market yet. So they'll be happy to sit on their hands. Right.
So we handed out a bunch of electricity subsidies, right? That's what brought down electricity.
Yeah.
But it didn't bring down inflation at all because we didn't count it.
Yeah, we didn't count it. But yeah, so it gets trimmed out in the trimmed mean.
Okay.
And also the RBA has said that they're looking through the electricity subsidies because they don't think that that's real because it'll just bounce back after. But that's a little bit before. Like this is kind of the interesting political economy kind of question at the moment is like how long will these subsidies stick around for? If toll road subsidies are anything to go by, they'll be there forever. So like it's just kind of we'll just keep funneling money to the gas cartel.
Right.
And in which case, if they are sticking around forever, then the RBA shouldn't be ignoring them. They should be looking at them and going like, yep, that's inflation coming down and
right. So what
done.
we need then is a commitment from someone that they will or won't be around forever.
Yes.
We'll never get it.
Not from a politician, no. They're not famous for
big long-term commitments like forever.
Yeah. Yes.
I can't even promise what's happening in a month from now. So I'm certainly not going to promise forever.
But I mean, if the electricity subsidies are to be wound up, that's going to be next year, which is an election year.
Yeah.
It's kind of hard to see that happening in an election year. It's going to be pretty tempting just to roll those forward. Otherwise, people's electricity prices jump 50%.
Yeah.
In an election year.
But the good news would be we still wouldn't count it because a jump of 50% would be outside the trimmed mean.
It would, yes. RBA would look right through that one.
So in this magical land of the RBA where we just get to pick what we look through and what we don't look through, then we are unaffected by big changes. It'd be worse, actually, if electricity prices jumped 6%. Because they might then qualify.
Oh, yeah. Qualify, yeah.
All right.
Yeah. Good dude.
Okay. So inflation's still too high. Where's inflation coming from then? If we're not looking at electricity.
Kind of a few sort of generalize things. There's an interesting chart here, which I thought was really interesting, looking at the split between goods inflation and services inflation. So goods inflation is done and dusted. That's down to 1.4% now. So that was what drove the big spike in 2022 was goods inflation, and mostly through tradable goods inflation because you had the global supply shock. So everything that we're importing from overseas, the price of that was going up. So that pushed up goods inflation and that pushed up the headline. And services inflation peaked probably about 6 to 9 months after that. So it's sort of with a bit of a lag. But it's, taking its time to come back down. So it's holding at 4.6%. It actually picked up in the last quarter too, which is not great.
So the goods got cheaper, but the people bringing us the goods started charging more for the privilege.
Yes.
Right. It's a tricky thing,
like
this economy, isn't it?
Running an economy is tricky. Yeah.
Okay.
Yeah. So I think the RBA will be looking at that because like services inflation is much closer to an idea of endogenously generated inflation. So stuff that's coming from within the Australian economy. And at 4.6%, that's a little worrying. Like that's not job done. Yeah. Goods inflation at 1.4%, that's jobs done. Yeah. We're good. We can go ahead with rate cuts. But services inflation at 4.6%, that's a little worrying.
Right. I mean, if we jack services inflation right up around 17%, though, we could look through it.
I don't know. I think that's sort of like 60% of the basket of goods.
Don't tell me how to RBA. Right, Thomas, we got some consumer sentiment data. You'll find the chart on our pages. Things are looking good. We're happy. Happier.
Yes, yeah. I mean, I think we'll look at this quarter right now as peak panic.
Oh,
or like
that's not how. That wasn't my read of the chart. My read was things are looking more optimistic. But let's go with peak panic.
Yeah, no, they are. There's a slight improvement, but I think for households, I think we'll look back at this quarter as the quarter just gone as being as tough as it was, as it was going to get.
Okay.
We're passing peak panic, I think. Yeah.
All right.
I mean, there's an interesting survey from Finder. Who they said that 1 in 3 mortgage holders, which is like 1 million people, 1 million households, think that they've borrowed too much money on their mortgage.
Right.
Yeah. So that's 1 in 3, 33%, and that's up from 21% last year. So that's a big jump in 12 months of people on their mortgage going like, oh yeah, we probably reached a bit too far there.
Or people just looking around their house going, oh, it's a bit of a dive. I reckon we paid too much.
Pay too much, yeah.
maybe not.
And there's a sort of a not a gender dimension. What is it? A demographic dimension there. So like half of Gen Z, almost half, 46%, reckon they stretch themselves too far.
Right.
So yeah, but that makes sense because they're your younger, more at-risk borrowers.
Yeah,
more likely to get in recently. So.
Okay, but so these people were panicked, but that's starting to drop off. Is that what we're seeing?
Well, no, I mean, that's up. So Finder's saying that's jumped up. So that's a little worrying. They also note 1 in 5, so 20% of borrowers say that they've missed at least one repayment. So, yeah. So that the indicators of mortgage stress are as high as they've been in, the last 10, 20 years.
Right.
So that's a little worrying. But it does look like the cost of living pressures are starting to ease, or at least they're not getting any worse. So like with headline inflation at, 2.8%, or 3.5% on the trim mean, that's still a bit elevated, but it's kind of normal inflation. Like that's not the kind of crazy inflation we saw. Like, 6-7% was very unusual. So now we're sort of getting back to sort of more normal times.
Yeah.
NAB has a consumer stress survey, and they're saying that the people reporting a very high level of cost of living stress has fallen in the most recent quarter. So that's, got up towards 33% in 2023. It's now down to 29%. That's still quite elevated, but it's turning a corner.
Is there a normal for that sort of level? Like we're talking about like they're saying people reporting and very high is the level.
Yeah.
So that is there, and when we say that's elevated, is there a sort of base level that we're working from?
I don't think the survey's old enough for that. Okay. I think... Yeah, no one was interested in cost of living stress for all of the 2000s up until post-COVID because cost of living wasn't a stress issue. So no one's doing a survey on it.
The good times, as we remember them.
The good Yes. Yeah. So I don't know, but yeah, I mean, it was 20% in 2021 when I think that's when they started, and then it jumped up to got up to 33% now, and back down to 29%. So
right. So cost of living stress is coming down a little bit, and we're feeling more optimistic though about the future.
Yeah. So Diane Durham have a market pulse survey. They had a question there. Thinking ahead, do you expect you'll be in a better financial position a year from now than you are today? That's now up to 30% of people agree with that, saying, yep, I'm going to be better off next year. That's jumped up from 20.
30%. Wow. Good job, everybody. That doesn't feel like a great result. It feels like it's still 70% of people that are not feeling that.
Think they're going to be the same or worse. It's true. But it's up from that 30% is up from 24% 3 months ago. So that's a pretty substantial step up in 3 months.
Yeah, right. Taking more of a glass third full approach to future.
The glass isn't 2/3 empty. 1/3 full.
All right, why don't we take a break here, we'll grab a word from this week's sponsor and be back with more Comedian versus Economist right after this. Welcome back here on Comedian versus Economist. You can send us an email if you feel like doing that, equitymates.com/CVE via the web, or send us an email to cve@equitymates.com. Thomas, in case house prices going up wasn't bad enough, land prices, it turns out, also going up. What's going on with land prices?
Yeah, so some data out of the Urban Development Institute of Australia, UDIA. They have lot prices just up and up to $650,000 in Sydney for a lot of land with no house on it.
And when we say a lot of land, we mean not much land.
Not with not a lot. Yeah, it's a nice segue. Yeah, because that's the other data they give us. They give us median lot size. So for Sydney, for example, in 2013, it was up around 550 square meters per lot. Yep. It's now down to 425 square meters. Yeah, so a substantial decrease in lot size. So not only are lots costing more, they're getting smaller.
Yeah, right. And I bet you they still come in the same size packet.
That's right.
little shrinkflation gag for the listeners out there. I mean, this doesn't seem like a revelation, right? This doesn't seem like it would be surprising that house prices are going up, therefore land prices are also going up. Maybe a little surprising that you get less land.
Yeah, I mean, I think it just points to how bad things actually are,
right?
In terms of affordability. But I think it's interesting in the sense, like, it's always worth to remember when you're talking about a house, you're talking about two assets. You buy the land and you buy the dwelling, and the land is an appreciating asset. Typically, the land goes up in value, while the built component is a depreciating asset. It falls in value because it gets older and stuff needs to get replaced. You're buying two assets in one when you buy a house.
I never really thought about it like that. I always just thought, like, buy property and, like, my house is a good investment. It didn't really, it makes total sense now that I think about it, but it didn't really occur to me that my house was actually a depreciating asset, especially the way I take care of it.
And when you look at, there's a chart here looking at Australian housing values to GDP. You can see that there's been a big lift in the housing values to GDP, up from like 2% in 1990 to about 4% now. But all of that gain has come through the land component.
Right.
So the structures component, that was about 1% of GDP in 1990. It's about 1% now. The residential land component's gone from 1% up to 3%. So all of the increase we've seen in property prices over the past 30 years, that's entirely in the land component.
Yeah, right. That's interesting. Is part of the story here like population growth? And so around my area, we see like any land that's bigger than whatever the minimum is to have two houses on it is pretty much getting sold. Whenever it gets sold, someone just comes in like, yeah, I'm just putting two new houses on this piece of land. Like, do you think that's playing into it as well, in that the land sizes are getting smaller every time they get sold?
Yeah. I mean, that's the thing, like that shrinkflation in land feeds through into, it increases the value of existing lots because they have existing sizes there.
Yeah.
So as new lots get smaller, existing lots become more valuable. Yeah, and also because there's that, plus the changing nature of land in the sense that land gets rezoned, you can increase density limits, that sort of thing. That also increases the value of land.
Right. So if my house is depreciating and my land is appreciating, what if I own a unit that's sitting on top of someone else's house? Like, how do I value the land then in that scenario? I mean, it's just the location.
Yeah.
Maybe.
I mean, you own a share of the land.
Share of the land, yeah.
If you could think of, which is a little bit why, units will never be as valuable as detached houses on a, like for like square meterage basis. Because you don't have as much control. You don't have as much land as your share. You also don't have as much control over the land as if you owned the full house.
Yeah, true. Yeah. Difficult to erect a granny flat on the back veranda of your second story unit.
Yeah.
All right, Thomas, talking media. Who still trusts the media?
Heaps of people, apparently.
Heaps of people. We're talking mass media here, right?
Yeah.
Heaps of people still trust mass media. Right. Well, that's good.
Yeah.
I think.
Well, yeah. I mean, it's interesting. This is the US election week when this will get released. And so, you've seen a real splintering of media and a real rise in you can't trust the mass media.
That's mainly from one guy, isn't it?
Yeah. But everyone's got on board with that idea, right?
Yeah.
Republicans weren't campaigning on the media lies to you historically until Donald Trump. And now they're like, we're all on board with that. The media lies to you.
Fair enough.
Yeah.
Right.
Yeah. So you go back to like the late 90s. And so this comes from a Gallup survey in America. So 55% of Americans in the late 90s believed that they had a great deal or a fair amount of trust in the mass media. That's been one-way traffic since then, and it's now down to 31%.
Yeah. I don't find any of this surprising, but I find it disappointing that it's gone down as much as it has.
Why are you disappointed?
Well, I think largely because the alternative to mass media is social media, and social media is just like just a cesspit of crazy. Yeah. And so I long for the days of like the newspaper and just having, a couple of researched articles, views, and sure, they're not always correct and they're not always maybe as good. But now, like, we just pump it out and then there's social media, which, and maybe the alternative to mass media isn't social media, right? There's independent media and stuff too, smaller media. But I don't know. I think I want to trust mass media a lot more, but also the quality of mass media has like deteriorated immensely. Like if you go to news.com.au or whatever and have a look at the top story, it's probably something about, Bex and Posh or whatever. So
because they're competing for likes in the ecosystem now.
Yeah, that's right. Yeah. So I kind of just I long for the days of actual news. Even if it wasn't totally unbiased actual news, that's fine.
Yeah, I mean, I was involved with a crew called Indie Media in the early 2000s. It was a bunch of techie guys, but the dream was like with the internet coming, it was just like, we could have a distributed news network where citizens are uploading their own news, and we don't have to go through the filters of like a mass media and like all the agendas that sort of come into play there. But man, that did not happen. Like really,
it did, but it did. Yeah, it did. It happened, and that was the problem. It didn't really work very well as a model. When you just have everybody shouting at the same time.
Yeah, humanity's still looking for a solution here. I don't think. This is a nut we haven't cracked. Yeah,
because 31%, it still seems like encouragingly high, but if you look at the trend, it's downwards and going to head Like what's going to arrest this decline? If it's gone from 55% to 31%, if we're talking again in, what was the start of that one? 2000. So if we're looking again in 20 years, where are we at then in 20 years?
Yeah. Well, yeah, we're down in the tens if this trend line doesn't shift. But I think as you're saying, I think like surely at some point people start to realize that you just can't listen to some randoms on social media for an unbiased take on things. Right? Like surely that's got to happen.
No, because what will happen, you just ask, people stop thinking for themselves a bit and just start asking like, who should I listen to? And someone will go, oh, well, this guy, you listen to this guy. He gets it. He's got it. It's probably people like, we're just people now where we've got a podcast. We're effectively in the media. People listening to what we say, thinking that we're unbiased, and we are.
We know what we're talking about.
I don't know about you.
Yeah,
I'm not smart enough about this stuff to be biased.
I don't know if uneducated is the same as unbiased.
All right, that does it again for this week. Thank you so much for tuning in. We really do appreciate it. Love it if you left a review for the show wherever you listen to your podcasts. Like and subscribe, all the rest of it, whatever you can do, whatever buttons you've got on your player other than skip, just push them. Don't just push, go the next 30 seconds and get to the end. Just like do some action. All right, thank you so much. We do appreciate it. We'll talk to you again next time on CVE. Until then, it is bye for now.
Comedian V Economist is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Comedian V Economist are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. For more information, head to the disclaimer page on the Equity Mates website where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Comedian V Economist acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander people today.